Welcome to Wealth Up, a channel about personal finance and building wealth. One important aspect of building wealth is to have your money grow and grow in a way where you are not exchanging your time for money. Rather, your money is working for you and growing without your effort. That's right, have your money grow while you are living your life. The way to do this is to invest, specifically to invest in the stock market. Investing in the stock market is something that may be scary and foreign, but it doesn't have to be. When thinking about investing, we often think of screens full of figures, tables, and plots. We think of investing in the market as being something that men do. However, in this video, I will discuss the basics of investing and define the commonly used terms so that investing will not be so scary. The more you learn about it, the easier it becomes. The intent of the video is to help you understand the terminology used so that it's not so overwhelming. With that said, let's jump into the video. Investing means that you put money into something where you expect a benefit in the future. In finance, this is called a return. There are many ways to invest, and one of the common ways to invest is in the stock market. Let's start with defining stock. We've all heard about investing in the stock market, but what is a stock? A stock is a way for companies to raise capital, in essence to raise money. And the common way that they do this is by selling part of the company off, and they do this by selling shares. Shares is a small portion of the company. All shares have the same value, no matter who owns them. And owning shares entitles you to part of the profits. A person who owns a share is a shareholder. If a company makes profit, you are entitled to part of the profits. They are paid out in the form of dividends. You can also expect the price of the shares to increase if the company is doing well. A dividend is the money that the shareholder is paid out regularly, which is based on the profits. The company will set the frequency, but it's typically quarterly. And they will also specify how much a dividend would be based on the profits. Each company will be different. Now, let's talk about the different ways to invest. Of course, you can purchase individual shares. If a company is publicly traded, you can purchase a share on a number of different platforms. However, before you buy a share of a company, you should first understand the financial position of the company and determine if it is a good investment. To do this, you must evaluate the financial statements, which detail the financial position of the company and are audited and can be trusted as accurate. I will not go into detail here on how to read financial statements or how to evaluate a company. If you are interested in this type of content, leave a comment down below. If you are new to investing, be cautious here and ensure that you know what you're doing before you put your money into individual companies. The reason is that if you invest in one company, all of your money is tied to the performance of that specific company, and it leaves you very vulnerable. A way to work around this is to invest in index funds. An index fund is a basket of shares for multiple companies, and they can also be from a range of industries. These funds can be stocks or bonds. A bond is an IOU from a borrower to the investor. You are in essence lending money to them. These are not tied to performance and can be from a company or a government. The return of the investment is shared with you up front and you know how much you will make. It is usually much lower than what you will get by owning stock, but the risk is significantly less. Warren Buffett, a phenomenal investor, recommends index funds as a way to save for later years in life. One common index fund you may have heard is the S&P 500, which stands for Standard & Poor's 500, which is an index containing the top 500 companies in the US. It is a mix of a variation of industries and historically has returned 9.8%. What this means is that every dollar increases by 9.8% per year. So if you invest $100, it will be $109.08 in a year. And you can imagine how this will have a significant increase over time. A second fund type is an exchange-traded fund, and these are commonly referred to as ETFs. ETFs are also a basket of different investments, including stocks, different index, or bonds. ETFs are listed similar to stock and can be traded just like stock. The price changes throughout the day, the same way you see the price of stock change. ETFs are some of the lowest cost funds. These are not managed and are simply a basket of investments. The cost of these investments is the expense ratio, and you typically see values less than 0.1% for ETFs. The third type of funds are mutual funds. Different to ETFs, mutual funds are actively managed. What this means is that a professional money manager is changing what is in the basket of investments. They are trying to get the best return possible for their investors. Because they are actively managed, they do have higher costs compared to ETFs, and therefore have higher expense ratios. These are not bought and sold like the previous investments discussed so far. They can only be bought and sold once per day after the market closes. The price is listed as the net asset value, or NAV, which is what you will see when you're looking at mutual funds. Although mutual funds are actively managed by experts and they try to get the best returns, there are many studies that show that index funds, like ETFs, outperform actively managed accounts. This may be surprising, but know that it is extremely difficult to predict what will happen in the market. There have been studies showing how stocks picked by monkeys, yes, monkeys, can outperform the managed stocks by experts. Due to the higher cost from the higher fees and the lower performance compared to ETFs, these are likely a better investment option. Note that this is not financial advice and you should do your own research. A big advantage of index funds is that it is an easy way to diversify. Diversification is a strategy used to lower your risk of losing money, but it also increases the likelihood that you won't see big increases in your investments. Diversification mixes investments from different market segments and different geographies. Because index funds are a basket of investments, it helps to broaden your investment reach. Another thing to consider is if you are a long or short-term investor. This will help define how involved you will be with your investments. Long-term investors hold their investments for at least 1 year and usually are investing for even longer terms. Investing long terms helps ensure that you do not lose money. It will allow enough time for the market to recover and the value of your investments to increase. Index funds are a great investment strategy for long-term investors. If you're trying to get rich quick, this is not the way to do it. In case you are a short-term investor and are more active, here you are holding the investment for less than a year, and you're actively reading and doing research on the companies where you want to invest. In your research, you are looking for companies that are undervalued and you want to buy cheap and then sell once the price increases to the value that it should be. In this case, you would be more of a day trader. Another type of investment are real estate investment trusts, commonly referred to as Reits. If you want to invest in real estate but cannot buy your own investment property or do not want to manage these yourself, a great alternative are Reits. Reits must give 90% of the profits back to the shareholder in the form of dividends. Another area to optimize your money is to use high-yield savings account to keep your cash. The interest rates you are getting from traditional banks is very low, and high-yield savings accounts offer higher rates. Of course, these interest rates are not going to make you rich, but they will at least pay you the most. Not sponsored here, but I have been using Ally for several years and have seen interest rates over 2%. And in the last year, it has dropped down to 0.5%, but it's still significantly higher than some of the mainstream banks. Now, let's talk about the different types of investment accounts. First, let's discuss retirement accounts. Note that the retirement age as of 2021 is 59 and a half years old. The first type is an individual retirement account, commonly referred to as an IRA. IRAs are investment accounts dedicated to save money for retirement, and they also have tax advantages depending on what type of IRA you have. The two options I'll discuss are traditional and Roth IRAs. A traditional account allows you to invest $6,000, that's for 2020, and you can invest into this account until April 15th of 2021. Or $7,000 if you're over the age of 50. This money is invested before tax, which means that this money is not taxed now, but will be taxed when you pull the money out at retirement. For Roth IRAs, you pay the taxes now and do not pay any taxes when you withdraw the money. Like the traditional IRA, you can invest $6,000 for 2020 and 2021, or $7,000 if you are over the age of 50. However, if you are single and you earn more than $124,000, your contribution amount decreases. And if you earn more than $140,000, you cannot use this type of account. This is only for Roth IRAs. Both investments can be done through a broker. The broker is what you use to invest. There are many options, including Robinhood, M1 Finance, and more traditional brokers like Fidelity and Vanguard. All of these are good options, and don't be overwhelmed by the number of options. Just pick one and start investing. Links will be in the description box below if you are interested. If you have a full-time job, you may have access to some retirement accounts. These could include 401k, 403b, or 457b. The names correspond to the section of the IRS code where they are detailed. Like IRAs, these accounts also have tax advantages. For 401ks, you can have a traditional account, a Roth 401k, or both. The traditional account is before tax, where you don't pay any taxes on this money now, but you pay it once you pull the money out in retirement. And a Roth 401k, you pay taxes now, but don't pay taxes when you pull the money out. The advantage here is that the cap does not exist for incomes above $140,000, as long as it is under your 401k, which your employer provides. Employers commonly offer matches in accounts like the 401k. The match varies between companies, and I recommend that you look into the details for your specific employer. They usually are something like they will match 3% of your investments when you invest 3% of your salary. If your employer offers this benefit, you should always invest at least enough to collect the full match. This is free money. Nowhere else do you actually get free money. The 401k has a contribution ceiling of $19,500. Again, this is for 2020 and 2021. Next, let's talk about a traditional investment account. This is not a retirement account, but investments that you have access to at any age. These traditional accounts are taxable brokerage accounts. Here you can buy as much as you want, and there are no limits. You can buy and sell when you want without any penalty or age criteria. There are different tax implications depending on whether you sell investments that you've had for less than a year compared to investments that you've held for longer than a year. Talk to a CPA. In these accounts, you have access to all the investments discussed at the beginning of the video. Next, I'll discuss a term that is very important, and it is dollar cost averaging. This is a strategy where the investor buys investments over time. This takes care of the volatility in the market and ensures that you buy at low and high points. And in general, you do not buy in the extremes. This also means that you buy no matter how the market is doing. And it has been proven to be a very effective investing strategy. This leads me to share a great quote about investing and one that I live by. It's about time in the market, not timing the market. Start investing as early as possible and continue investing. Even in the down markets, continue investing. If you are young, the down markets are an advantage for you. You're buying at a discount. Rather than considering not investing, you should be investing consistently, or even more than before in the down markets. I hope that you have enjoyed the content and learned some new terms. If you have liked the video, be sure to give it a thumbs up, subscribe to the channel so that you see upcoming videos. If there are other topics you are interested in, drop a comment down below. If you want to see regular content, you could add me on Instagram at wealth_up. Thanks again for watching, and I'll see you in the next one.